Hello and welcome. This is Alexander Shapiro reporting for CMS Forex News. Today is Thursday, July 3rd, 2008. In the Eurozone, retail sales surprised forecasts on the upside in May, increasing 1.2% on the month and turning positive in annual terms at 0.2%. With the Eurozone economy losing its momentum, however, the good result may prove temporary. Activity in the Eurozone sector contracted in June, falling to 49.1 from May's 50.6. The final version was lower than the preliminary release from last Monday. In the UK, the services sector also contracted for the second straight month, posting a 47.1 for its PMI, the weakest level since October 2001. The UK economy has hit the skids as a collapse in housing lending, stemming from the U.S. subprime mortgage crisis, has turned into a full-blown slowdown and possible recession. In the late part of the European session, the ECB delivered its announcement on interest rates, raising the rate to a 7-year high of 4.25% in order to combat red-hot inflation. It's the first move by policy members in 13 months. It comes despite signs, such as today's services data, that the economy is cooling. The increase was signaled far in advance and was not a surprise to the markets as annual consumer inflation hit 4% in the June preliminary release. The surprise to the markets came in ECB Chairman Trichet's comments following the announcement. He signaled that the bank may have taken a one-and-done approach and are not likely to start a series of increases. Those traders expecting a more hawkish stance on inflation were disappointed, and the euro-dollar pair slid close to 200 pips prior to tomorrow's 4th of July holiday. European stocks were negative to start their sessions, but climbed into positive territory as anxiety about more ECB rate increases receded. The euro-yen pair succumbed to the euro weakness, however, stalling its recent rally, which was a recovery from last week's slide. From its intraday high today, prior to Trichet's conference, the pair fell around 150 pips by 2:30 p.m. Eastern Time. The pound-dollar pair slid 120 pips from its open as the pound was pressured by its services report. At the New York Open, the U.S. release of non-farm payroll data did not stop the dollar's momentum. The pound is now 200 pips lower than its high for the week at the 2-to-1 level seen on Tuesday. In the U.S., the non-farm payroll report showed the economy shedding 62,000 jobs, the sixth straight month of job losses. The fall was very close to the forecast, perhaps a relief after a weak ADP jobs report earlier in the week. May's figure, though, was revised down 13,000. The unemployment rate remained at 5.5%. The job market seems poised to remain weak, which can lead to lower consumer spending and may keep the Fed from raising rates despite higher inflation. U.S. stocks digested the job news and turned slightly positive by the middle of New York trading. With dollar strength dictating the market today, the dollar-yen pair rose to a new week high of 106.9, recovering some of its losses from the end of last week. The dollar also managed to pair yesterday's losses against the Canadian dollar. The US dollar loonie pair had tested 1.01 yesterday, but jumped back above 1.02 today. The pair got caught up in general greenback strength as some had feared a worse jobs report and a more hawkish ECB, which did not materialize. The gains also came despite another jump in oil prices, which pulled back from a record near $146 per barrel. In upcoming releases, Germany will post its factory orders overnight, and the UK will release data on housing prices. Tomorrow, the US will be celebrating Independence Day, with national banks and stock markets closed for action. Canada ends the week with its IV PMI. Have a happy Independence Day. Join us again next week for another edition of CMS Forex News right here on CMSFX.com.